Good day, Market Chameleons and everyone joining for the first time. Thanks for coming by to the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. He's going to be talking about charting option risk premiums. How you doing, Dave?
Good morning, Will. How are you?
All right, let me share your screen. There you go, and it's the Market Chameleon landing page we're landing on, and let's go.
Good morning, everyone. So what we'll do today is kind of continue our conversation from the previous show, and we're going to plot option risk premium, but this time we'll go a little bit further and compare two different risk premiums. So let's do that by example. I'm going to go to stock symbol. Let's use SPY today. So I'm going to type in SPY. This will take us to SPY's summary page. And on the left-hand side, we're going to go to the menu, click on volatility. We're going to click on risk premium. This will bring us now to a new page. And I'm going to click on this menu to minimize it and expand our screen. So what we first discussed, in just a recap, is another, besides plotting implied volatility that's derived from option prices and charting the historical implied volatility, we could use that same idea and benchmark option premium. And in this case, we defaulted to a 30-day constant maturity because we discussed when we look at option premium, you could have different maturities. You could have 7-day maturity, 30-day, 90-day, whatever, whatever maturity. But they'll have this just because there's more time premium in further out options. You're going to have a different premium. So when we benchmark it, we have to kind of define what are we benchmarking. So in this case, we're defaulted to a 30-day constant maturity. We could change these, but this chart here looks at a 30-day option. We also discussed that options can have different strikes. So a strike price, let's say that's 10% above the money, is going to have a different premium than something that's at the money. Or something 20% out of the money is going to have a different premium than something 10% out of the money, because that option that's 20% away is further out. The stock needs to increase by more for that option to be in the money. So the premium would reflect that and be less. So we have to define, well, we have the 30-day, but what reference are we for the strike price? What are we referencing? So this is defaulted to at the money. So it's creating this synthetic option based on the surrounding data of a 30-day at the money put. If we wanted to change that, then we could define it by percent away. So stocks have different strike prices, and the different strike prices, they're relative to the stock price. So when you have an option or a stock that's $100, and you have a 105 strike, that's 5% away, right? So we would want to define it in something that we could kind of normalize to create analytics across time and across assets. So we define the strike price as percentage away, right? Because you could have a $200 stock, and then you would be looking to add a 210 strike, right? For that 5% away. So we define it by percentage away. At the money is right at the stock price and the strike price would equal. So now we have this chart, and what does this chart show us? We're not looking at implied volatility. We're looking at a premium, option premium as a percentage of stock price. Okay, and this allows us to look at it as a percent. What would be the cost of that option to insure, the stock? So when we do that, as you can see here, this is a percent. What we're kind of then looking at is if we wanted to know, well, if I wanted to insure buy put at the money put, and I wanted to insure downside, what would it cost me? So by doing a percent, you're saying that for every $100 worth of stock that I own, it would cost me X percent in option premium to protect that downside. So here we could see, in this situation right now, it's 1.6%. Or for 30 days, it costs you $1.60 to insure $100 worth of stock. Okay, so we're looking at, not stock price, but how much risk you have notionally in the stock and how much would it cost you to protect that risk. Now we have this. So we have this chart, and we could see it going back over time, see how high, how high it got, how low it got. So it fluctuates, and that just makes sense because markets are dynamic and there's different risks at different times, or different perceived risks at different times. And now that we could kind of look at that risk premium versus its own historical range. What if we wanted to expand that and look at a difference between two options? What if I was looking to buy one and sell a different one? What would that total cost be? So let's do that. Let's say we're looking at a 90-day, right? I'm just going to change the maturities for now and keep the strikes at the money. So let's say I'm going to do a 90-day maturity. Let's just load that first. So you can see that the 90-day would cost you 2.4% of stock price, right, on a relative basis. So it costs you to insure $100 worth of notional risk in SPY, costs you $2.40. Well, what if we wanted to compare that against the 30-day to say, well, we're willing to insure for that 90 days, but we don't think in the next 30 days anything's going to happen, so we finance some of it by selling a 30-day premium. Kind of look at a time spread, 90, 30-day. So then I'm going to add this comparison. What this will do, it's defaulted to 30-day. You change it at the money put. So what we're saying is, how much would a 90-day put minus a 30-day put cost, right? That combination. What would it cost today? So if on a relative basis, if the 90-day put is kind of staying stable and the 30-day put is increasing, if the cost of that insurance is increasing, the 90-day isn't, then the relative cost to buy the 90, sell the 30, it would, on the net debit, would be less, cheaper. It would be more expensive if the 90-day was increasing on a relative basis historically, while the 30-day is decreasing or staying the same. So how much right now would that time spread cost? Again, we're going to do it as a percentage of stock price. So let's reload that. So now we have this cost where you could see that it would be 0.83%. So keep in mind, you're selling one, buying another, right? So that's why there's a difference. You don't just buy one, you're buying one, selling another. So that's 0.83%. So you could see that is below that orange line, which is the average. And this is telling us that the shorter term risk premium is starting to get elevated relative to the longer term premium from a historical perspectives. So right now we're seeing more risk on the shorter end. The markets are anticipating more volatility right now on a relative basis. So we could see how the difference, how high got and how low got, and this kind of gives us a visual of what a time spread would cost if we created a 90-day, 30-day, index. But we could also do a diagonal, or we could do a difference between the strikes, the difference between where at the monies and out of the monies. So let's try to do that. Let's stick with the 90-day at the money. Let's go to the 90-day 5% out of the money. How much would that cost us? So here, what this is saying is, right now, it will cost us 1.29%. Okay, so if we thought of, a spread that's 5%, right? 5% apart from at the money to the, just to make it, let's say, to make it easier, if we're looking at, 5%, $100 strike versus a 95 put, right? That's 5%. Well, it would cost us 1.29% of stock price. So $1.29, right? To potentially, if that whole spread is in the money, it would be 5% difference between, 100 and 95 would be 5%. So it's $1.29 to potentially make a $5 spread, $5. Okay. So that is a way to see, well, if we're doing a vertical 90-day constant maturity vertical spread, 5% apart, strikes 5% apart, it would cost us $1.29. And this is how high got historically and how low got. Okay, so then the relative cost of the vertical spread, right now it's above the average, right? 1.29 versus average of 1.18. Okay, so that cost of that vertical put spread is a little bit above the average, but you could see that it fluctuates. So that's a way to kind of benchmark a vertical spread, right? We could also do two out of the monies. What if we were looking at something that's, let's do 5% and 10% away. So these are out of the money spreads, right? So we could do, you don't have to use at the monies, you could do an out of the money put spread, right? So 5% away minus the 10% away, right? So the 10% away would be cheaper than the 5% because it's further away. So let's do that. So here, I'm saying that a 5% put spread, but it's because they're still 5% apart, right? The strikes are 5% apart, 5% and 10%, but they're also the high strike starts at 5%. And so this is an out of the money put spread. And you can see that right now costs 0.8%, so close to the average 0.51. Okay, so now we have a way to kind of look at the differences and chart what a strategy may cost, synthetic strategy with a vertical spread. We could go further and do even a diagonal. So what would a diagonal look like? Well, we could do a 90-day 5% away, and we could do a 30-day 10% away. So think about it as you're buying in this case, buying a 90-day to maturity put that's 5% out of the money, and you're selling another put 30 days to maturity, but that's 10% out of the money.
Hey, D,
Yeah.
we wanted clarification. Someone's asking, actually, it's Jim. He says, Will, so in this chart, the primary is a buy long and the comparison is a sell short?
Well, like, yeah, because I'm doing, so wherever you add here, right, the comparison will subtract it. So yes, so in this situation, it's a kind of a long minus because you're doing a minus. So that would be a short. Okay, so this
Right.
isn't, so that would be, yeah, one minus the other. So over here, see 90-day premium minus 30-day. So it's over here. I'll explain to you. So yes, so this is a minus, one minus the other. So whatever you have here, it would start like as a plus, like a long, and this would be a minus on this side.
So Jim then goes on to ask, so if I wanted to look at a debt calendar spread, I would have the shorter time frame as the primary and the comparison as the long.
Wait, say that again.
So if I want to look at a debt calendar spread, I would
debit.
I would have a shorter time frame as the primary and comparison as the long.
Well, the reverse. So you would have the debit is on this side, the credit is on this side. So it starts as a long minus, right, the other. So it creates a short. So
Awesome.
let's like the way I have it here, this is a long time spread starting 90 days and that comparison 30 days. So and you could see here, because this is a debit, if I reversed it, let's say I did a 30-day long and a 90-day short, you could see now it's a credit, right? It's a minus 0.10 because the 90-day, the minus would be higher. Okay, so I'll go back.
Perfect. Thanks, D.
Yep. So in this situation, this last example we'll do for today is we start out at a 90-day constant maturity, 5% out of the money put. And then we're going to say, well, how much would it, if whatever the cost of that is, what if we sold a 30-day constant maturity, 10% out of the money put? So this is a diagonal because now we have two different expirations, 90-day, 30-day, but we're also using two different strikes. One's 5% out of the money, the other one's 10% out of the money. This one's further out of the money. So now we could see this would cost us 0.94% of spot price. Okay, so imagine you have $100 stock, costs us 94 cents to do that spread. Okay, so and obviously $200 stock would be twice as much. So you just, but in your head, if you just quickly normalize it to $100, that would be that would be the cost. That's kind of what an easier way to think about it. All right, well, I'm gonna stop right there and throw it back to you.
Great job, D. As always, my friend. You have a great weekend and enjoy the Super Bowl.
All right, thanks everyone. Stay safe. Have a great weekend. Have a great trading day. We hope to see you Monday.
We'll see you Monday, D. Thanks, buddy. Hey, everyone. I forgot to ask, who's everyone want in this Super Bowl? I think I'm rooting for the Seahawks myself. I was about to put a poll out there and forgot. I did want to show something. Let me see if I can share my screens. It's always amazing how creative the community is of chameleons, but one of our favorite Midwestern chameleons from Cincinnati, Cincy, created a couple of his own custom bikes. There's one of them. Very cool, Cincy. I really appreciate you sharing that with me. I did share it with a couple of the email chains I'm on just to show that. Let me see if I can get the other one up. That's one of them. Mike's probably kicking his screen because I'm taking so long to share my screens. And this is the other one. Very cool bikes. Built all by himself. Mike, you may want to buy one of those off Cincy. All right, everyone have a great weekend. It looks like we have one Seattle, another. Well, that's Swami. Swami's the only one who's going for Seattle like me. I guess everyone. Well, Mike's against the Patriots. All right, good to see you. We have 3 Seattle fans. Everyone have a great weekend. Remember, thumbs up. Follow us on all the social platforms. And we'll see everyone Monday, 9 a.m. Have a great weekend, everyone.